Our next guest had a front row seat during the financial crisis, and she is worried a meltdown could happen again due to risks tied to Fed tapering and stimulus measures. Let's bring in Sheila Bair. She was FDIC chair from 2006 to 2011. Sheila, great to have you with us.
Thanks for having me.
Choosing the term financial crisis is really tricky because it's like you're shell shocked and you think back to the great financial crisis, but you chose it very specifically, and I'm wondering what you see could be the scenario here.
Well, I don't think it'll happen. I think it's avoidable, but I do think interest rates are going to go up. I think that asset valuations are elevated pretty much across the board. And a lot of that's driven by monetary policy. So as monetary policy becomes less accommodative, some of those valuations are going to start dropping. So I think you can do that on a slow, steady basis. But let's not forget what triggered the 2008-2009 financial crisis was when Fed just went a little bit too fast on their interest rate hikes. And so this is very tricky. And the history of tightening is not always a positive one in terms of being able to exit these accommodative policies without a negative impact on the economy. So I think it's avoidable, but I think the Fed's got a very significant challenge in front of them, starting with tightening with taper and then eventually interest rate increases.
Sheila, it's Tim. Thanks for joining us. Is there a part, though, of the economy? It was easy to look at banks in the pre-crisis lead up as taking excessive risk and the inability to value derivatives. Banks seemingly have very different balance sheets and business models. Where are you concerned in the private sector?
Yeah. So they're in better shape. Are they as good, as strong as they need to be? I don't know, but they're in much better shape. They have de-risked. A lot of the risk has gone outside the banking sector. So there is another crisis. I don't know if it's necessarily going to be with the big banks, but there's a whole financial ecosystem out there that's pretty highly leveraged. The corporate sector is very highly leveraged. A lot of reliance on short-term debt. Again, that's going to create stress for the weaker companies. They're going to have to keep refinancing, and the rates are going to be going up. So I don't know if it's going to start with the banks. It'll probably start outside the banks, and I hope it doesn't happen at all. Again, but I think I have been a longstanding critic of this highly accommodative monetary policy, but I tell you now, I think they need to go slow. Jay Powell suggested that they would, end taper by mid next year. That's pretty rapid. I would rethink that. I think they need to do this. I think inflation's a real concern, but it needs to be very gradual because look, it's been a long time since interest rates have gone up, and we're just not quite sure what the outcome of all this is going to be.
Sheila, it's Karen. Thanks so much for being on. Let me ask something about. It sounded like you were concerned about banks being, sort of in '94 there was that negative duration, but now they're so asset sensitive. It would seem like that wouldn't be a risk. Are you more fearful of credit quality from corporates becoming underwater?
Again, yes. I mean, again, I don't think this is necessarily going to start with the banks. The banks are better capitalized. They have to deleverage to some extent. I think it's going to happen. Yeah, but sure. Even if it starts someplace else, it's going to cascade back and hit them. Corporate debt, a lot of it will be, experienced in the financial markets, though. A lot of these assets are not held on bank balance sheets. So, again, I don't think the crisis is necessarily going to destabilize the banking system. It may. We just don't know. But I think there is a real risk of financial turmoil and a lot of investors getting hurt. And if it cascades into a negative economic situation, a downturn or recession, we could have a problem. And again, that's going to create, credit losses that will flow through back to the banking system. So I think all of this can be avoided, but the Fed just needs to go very, very slow.
Sheila, I'm curious.
We've been in this a long time.
Yeah, I'm curious to hear where you think this could start. And it sounds almost like you're alluding to the shadow banking system and the entities that have lent money to various entities that may not be as creditworthy. And how does that, if it's in the financial system, in the banking system, there are bailout mechanisms which we've seen in the past. But if it happens in the shadow banking system, we've never crossed that bridge before.
No, we haven't. There will be, hopefully we will not have to, because I think longer term that's even more destabilizing to the extent that some of these non-bank players, prime example, money funds, asset managers. They've already gotten, targeted bailouts already. So I think there is a bailout kind of thinking is already set in to a lot of these non-bank sectors that incentivizes risk taking. So, and I do worry about the corporate sector a lot. And again, that could certainly have a very, very negative impact on corporate debt markets. And if that cascades into the real economy, then it's going to flow back onto bank balance sheets. Look, I think another possible scenario is not crises, but stagflation. I think there's, we've got constrained supply. We've got a huge amount of monetary and fiscal stimulus still flowing into the economy. Could be a lot more coming out of Washington. If supply is constraining economic growth and we keep pouring fuel onto the demand side, you're going to end up with stagflation, which could be another very ugly scenario for working families. It might not hit the banks so much or the financial markets so much, but it could have a real devastating impact on working families and lower income workers who are just finally now seeing some real wage growth. So that is another area that's very high on my worry list.
So I don't want to put words in your mouth, Sheila, but it sounds like you think that the potential outcomes, there's a higher risk for negative outcomes coming out of easy monetary policy than positive outcomes.
I think I think asset valuations are going to adjust. I think, borrowing is going to become more expensive to some extent. Long term, that will be a good thing. But yeah, short term, it's going to be a very difficult transition to navigate. And, best of luck. They've got a lot of talented people at the Fed. So, and I know, they're thinking about this morning, noon, and night, but they really need to be very careful and very gradual in how they start to taper and eventually raise rates.
Sheila, great to see you again. Thank you.
Sure. Nice to see you. Bye.
Sheila Bair. It's never good when you say best of luck. Dan, what do you think of all this?
Yeah, I think she brings up a lot of good points. If you look back at the history of our banking sector, they find every opportunity to kind of screw things up right when they think they got it here. You know what I mean? And I'll just say this about, I think she's right about the concern about stagflation. We just were talking about how interest rate sensitive some of these money center banks and reliant on lending. The investment banks, again, back to Morgan and Goldman. I mean, I think the trends that are in place, we really thought their business was going to fall off a cliff in 2020, and look at the results they've had into 2021, and they're supposed to be great in 2022. So that's where I'd focus. And the other one we haven't been talking about is MasterCard and Visa. Obviously not banks here, but those stocks are off maybe 13, 14% from their recent highs. They really haven't budged at all, and expected in 2022 at least 20% earnings and sales growth. I know that they're expensive about 30 times. Those also look pretty interesting to me.
Guy, quick thoughts? Sheila wasn't exactly a very uplifting for Thursday afternoon, but what do you think?
No, and she's not one for hyperbole, so when she says things like that, you absolutely have to listen. But one thing she said, it's going to be hard to navigate, and I agree with her there, but let me submit this, and then I'll let you go. It's extraordinarily hard to navigate if they look at it through the lens of the market. If the market is their concern, then it's almost impossible to navigate. If they take the market out of their purview and out of their sights, I think it's actually rather easy to navigate and just let the market do what it wants to do. But unfortunately, I think they become enslaved to the broader market.